Hello and welcome to Quilter Cheviot Markets Uncut podcast, your weekly insight into the topics and issues that we've been discussing here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you are listening on or by following hashtag QC Weekly Comment on LinkedIn. I'm Jack Bishop, investment manager based out of our Manchester office, and this week I'm delighted to be joined by our regular commentator and head of fixed interest research, Richard Carter, alongside Jamie Maddock, our global equity research analyst covering the energy and materials sectors. Very good morning to you both. The main news over the weekend was the escalation in the Middle East following Iran's drone and missile strike on Israel, which it stated was in response to a suspected Israeli strike on the Iranian consulate in Damascus earlier on in the month. Israel seems to have fended off the attack quite effectively using its various air defense systems, and now attention has turned to the response, if any, from Israel, with the US urging restraint. Friday marked the start of the quarterly earnings season, with large US banks kicking things off. However, the main focus last week was the inflation print out of the US, which came in hotter than expected, both at the headline level and at the core level. So in March, consumer prices in the US rose by 3.5% year over year and 0.4% on the month. And that was against forecasts of 3.4 and 0.3 month over month. So we're talking 10 basis points difference there on both. However, given it was the third sticky reading in a row, it has called into question whether interest rate cuts are wise, and continuing its current pace would see a 4% year-over-year inflation reading. So it's worth noting as well that the Fed's preferred measure of inflation is running about 1% below that sort of level. So, Richard, first of all, I think we should touch on tensions in the Middle East. Could you just give us an idea as to what the market impact has been this morning and the actual impact that we could see on client portfolios?
Yeah, I mean, so far, actually, the impact on markets has been relatively muted. And as you say, the fact that a lot of the missiles and drones were shot down by Israel and allies has made the whole thing a little bit less serious than it could be. And just think about how serious it could have been if half of those missiles had got through or something. We would be in a pretty bad place this morning. So, I mean, there was quite a few rumours then last week this was about to happen. Markets got sort of got the jitters on Friday. All prices rose, but then in the event, things haven't turned out so bad so far. So currently oil's down a little bit, and markets are fairly sanguine about it. And I think now it's really a question of how Israel responds and whether the US can sort of keep the lid on it in terms of escalation. Because clearly for markets, if there was a full-blown war between Israel and Iran, you'd worry about what would that mean for your price. Bad for equities, bad for parts of the bond market too, although I suspect there would be some sort of flight to quality. But let's hope we don't get into a full-blown Israel-Iran war. And at the moment, as I say, I think the US is doing its best to prevent that.
Yeah, so largely shrugged it off for now, but we'll wait to see what Israel might do. Turning our attention back to that inflation data that was out last week. So services inflation was really the main driver of the beat on versus expectations. And things like car insurance, which I think a lot of people can probably relate to, medical care in the US, and shelter costs. So if you factor those as well as the recent increases in the oil price following the tensions in the Middle East, it does complicate the picture a little bit to bring inflation back down to that 2% target. So aside from all the tensions in the Middle East, what was the reaction following the inflation data, particularly for bonds? And there was a treasury auction, I think, at the time. So there was some quite aggressive moves in yields. And if you give us some context, where were we at the start of the year on kind of 10-year bond yields in the US and the UK, and where are we now?
Yeah, you're right. You're right, Jack. It was quite a aggressive move in treasuries after the numbers, and as you say, it's the third straight disappointment we've had on inflation. We're not talking 5-6% inflation, but it's not that bad. But clearly, it's not. It's sticky. Some of the areas you mentioned, the service sector, like car insurance, they're holding up, and it doesn't. And the Fed can't really justify cutting interest rates at the moment, particularly as the labour market's pretty strong as well. So yeah, we have seen quite a big sell-off in bond yields this year, or rise in bond yields this year, I should say. So we were just sort of below 4% on 10-year treasuries at the start of the year. Now we're just above 4.5%. And in the UK, we were around 3.5 at the start of the year, and we're just above sort of 4.2 now. So it's not been great. Interest rate cut expectations keep getting pushed back. Although I would say on the positive side, you've got a pretty good starting level of yield in bond markets, and the rise in yields has happened without destabilizing equity markets too much. So actually, overall, for most portfolios, it's still not been a bad start to the year.
Yeah, I think that's probably been one of the most surprising things that's happened at the same time. So you touched on it just then. So where has that left the market pricing for interest rate cuts? So the ECB kept rates on hold last week, but again signaled that June's probably likely for the cut. And up until now, the June really had been talked about for the US, but it now seems that's pushed back to much later on in the year. So is the Fed's dot plot wrong? When we won't see 3, and would that upset markets?
Well, the dot plot will be wrong if we keep getting inflation numbers like we have had, although there hasn't been a massive change in sort of commentary from the Fed, but clearly there are some officials looking at the data and thinking, we're just going to have to delay this thing. So we'll have to wait and see on that one. I mean, the market at the start of the year was hoping maybe March we might get a rate cut, but clearly it's getting pushed back the whole time. And now the first rate cut in the US is expected to be September. So it could be, the Fed has to wait, but actually inflation here and in the Eurozone is a little bit better behaved. So maybe in the UK and Europe we might get a cut a little bit earlier than that. The UK now expected to go in, start cutting rates in August, but that's still a way off, as potentially we could get a little bit earlier than that. But as I say, the expectations for the Fed keep getting pushed back.
Yeah, so just touching on that. So in theory, what normally would happen is the US and everyone else follows suit. So if we continue to have, say, the strong labour market data in the US, we continue to have strong economic growth there, there's less emphasis and less need for them to cut rates. And if economies start to weaken this side of the Atlantic, as I guess you could argue they already have in the UK and Europe, would the ECB and the Bank of England be confident to basically start that interest rate cut cycle ahead of the US?
I think potentially they would be. I mean, I don't think they'd want to go, be cutting by 1% to 2% before the Fed's even started. But you might, you know what I mean. But you might see some sort of gradual or the initial 25 basis point cut before the Fed moves. I think you've certainly got growth in the Eurozone and here. It's just about positive, but it's pretty anemic, and it's certainly nowhere near what we're getting in the US. And wage data is improving slightly, and all the rest of it. So I do think the UK and Euro and the Eurozone could cut interest rates before the Fed. They'll be watching the currency because they don't want to cut too early, and then we see a big fall in sterling and the euro, and actually that can feed back into inflation going up as the currency weakens. So I don't think there's going to be a massive disconnect, but certainly at the moment it's pointing towards the Bank of England and the ECB going first.
That's great. And then just to the final question for yourself, Richard, putting a political spin on all of it. Biden, following the CPI print, came out to say that he expects the Fed to cut rates this year, but it may be delayed for a month or two. So central bank independence aside, Biden is clearly relying on inflation moderating by the time the election comes around. And you could argue it's the same here in the UK, Rishi Sunak hoping that rates will be down by the time he calls the election. So whilst the jobs data and economic growth has been strong, voters are probably still scarred by that cost of living crisis. So it'll be difficult to change that narrative if inflation doesn't behave. So do you think that could be a big issue for particularly the Biden re-election campaign, particularly if gasoline prices, which is a bit of a lightning rod for voters, begin to creep up again?
Yeah, I think that's right. And actually, the reason the Americans are preaching restraint in the Middle East is probably because they don't want to see a big war down there, for many, many reasons, including sort of peace is better than war. But clearly a war in the Middle East, which sent oil prices skyrocketing, would be a disaster for Biden in an election year for the reasons you mentioned. And I think, that's another sort of supporting factor for why the Americans are going to try and, as I say, preach restraint the Middle East. But yeah, I mean, economic factors aren't the only concern of voters, although normally it's pretty much at the top. There's also big discussions about immigration and abortion and things like that in the US. And actually, the latest figures suggest Biden's approval rating on the economy is improving a little bit. But if inflation were to spike back up again, that could go into reverse. So for now, I think he's probably feeling reasonably confident about where it's heading. But still some time to go until the election.
That's great, Richard. Thank you for your contribution. So, Jamie, if we could turn to you now, continuing the discussions really on inflation and the impact on rising oil prices and what that could mean. We know that is a factor in why the oil price has been rising year to date. Could you talk us through maybe how much of an impact that's had, and if some of it might be more supply side with production cuts from OPEC beginning to bite?
It's always very difficult to put a number around how much is in the price for geopolitical risk. I mean, some sort of estimates would place it in sort of high single digits, so anything from down to as low as mid single digits, so $4 or $5 up to say $8, give or take, is in the price for that. But that's based upon a sort of an exact science about the calculation of what the correct forward oil price should be, and then more or less disaggregating what the difference to that would be. But yeah, it's fair to say there is some element in it. I think what's, to your point around what's happening to this year, though, the rise in the price is in part, yes, been from the increased geopolitical risk premium being reflected in it. However, I think the larger contributing factor, and you pointed to it exactly right, which is the supply side adjustment that OPEC have made. And let's be clear, though, that it's not OPEC we're really talking about, it's Saudi. And Saudi alone is maintaining this modest deficit, I think is the best way of putting it. But broadly speaking, it's a balanced to slightly underbalanced market. So what they've done is they've removed sufficient oil from the market to enable the balance of the change in demand on a year-over-year basis. So more or less the extension of that earlier this year, or at least Saudi said we're going to extend the cuts that they had already in place, are one of the major reasons for where the price is at the moment. And the other thing, and this is more at the margin, and this hasn't really been picked up by the news, but is undoubtedly having some impact, is that the battle which is going on between Russia and Ukraine, they're starting to have the Ukrainian attacks are starting to have some impact on the production from Russia. Now that's primarily impacting products, but at the same time, some of their ongoing oil production operations are also being impacted by that. So whilst it's not been a formal reduction in supply output from Russia, there is at the margin a little bit less as a result of the damage caused by the ongoing fighting.
Okay, that's quite interesting. Yeah, arguably not very well reported. And gold, I guess, is another factor in terms of the tensions in the Middle East, and really commodities more broadly seems to be on a bit of a tear of late. But perhaps if we break that down into gold, so why has that continued to do well? Why has copper had a bit of resurgence as well, and even soft commodities such as cocoa and coffee? So could you just give us an idea as to what might be the driving factors behind those various commodities?
Well, I guess the great thing or the frustrating thing about commodities and why they could always have a position in portfolios is that at a very high level, you would think about commodities as being positively correlated to inflation and also some sort of dollar hedge too. But actually, this beneath that level, and of course, you've got the supply demand dynamics, but you've got the different drivers really. You've picked up a number of different commodities there, and to talk about the different ones. So first of all, gold. Why is gold done well? If you have any concerns around geopolitical risk, and you have concerns, say, and in itself, that can be a reason to own gold. But then add on top of that what seems to be rumbling along high inflation, or at least inflation which has not got down to levels that you might have anticipated it would have done as a result of the interest rate increases that we've seen. There in itself would be another reason to own it too. So in itself, That's less of a supply-demand dynamic of gold relative to some other commodities. But that said, even in this instance, actually, at the moment, we're seeing central bank buying of gold being a major impact or driver, at least for the higher price. So a number of different reasons as to why that's done well, and maybe even why people may wish to continue to be buying gold even at these levels. Then you move on to copper, and in many ways, the copper dynamics are a little bit different. So what about copper? So if you're thinking about a recovery and you're thinking about the global economy exiting the recession or exiting, I guess best way of putting it is economic growth returning to, I guess, more normal levels, copper is your most normal play on that, and you would express that via that. Add on top of that the simple fact that we're going to need a lot of copper to enable the energy transition. So again, there's a bit of a multi-factor impact as to why copper prices have been resilient relative to some of the other base metals, and then changing tack again, what's happened within some of the soft commodities, and it's a completely different driver again. So if you think about the significant increase in prices we've seen in cocoa and coffee, I mean, that is producer based. So these are not by a large they don't represent a large amount of the value of commodities traded. Now, if you're a producer of any of these, you typically try and hedge your exposure by selling the forward. So it basically works against any price movement there might be to try and hedge the impact there might be from any price moving. But when you get to the extent whereby future prices are moving because you've, say, had a drought or you've had a particularly wet season, the price can move very, very rapidly. And these are really thin markets. So not a large amount of money is traded in the financial market relative to, say, oil. As a consequence of that, you get these sort of compounding effects as if you have to cover your short if you're a producer of this product. Then you have to buy in the futures market and you push the price up and you try and reestablish your short by selling again. But of course, as we've seen prices roll higher because of the tightness in this market, because of some of the, I guess, the issues that really at the ground level due to really farmer production issues, you see this significant rise. So I guess the point really, if we step back and, let's not go into the weeds too much here, what do commodities do? They're diversifier. Why might that be? Because they give you all different types of exposure to different expressions of the global economy at different points in time, and at the same time have a number of idiosyncratic drivers which are not connected to, say, economic growth or the fundamentals of any company's earnings.
Yeah, quite a broad array of factors there. Sorry to pin those all on you, Jamie. And then finally, if we could talk about the valuation gap between some US and UK stocks in your space. It's often cited as a series of high-profile delistings in pursuit of higher returns. Shell was the latest company to be rumoured to consider a listing in the US. So the CEO recently commented that he has a location that clearly seems to be undervalued. And then the previous CEO last week again came out to state that the oil major was massively undervalued in London. So firstly, are they correct? What is the valuation discount between the likes of BP and Shell versus the other US oil majors such as Chevron or Exxon? And are we comparing like for like here in terms of earnings growth, portfolio composition, shareholder returns? And is the recent flurry in kind of the M&A activity over in the States a factor which we hear maybe less of here in the UK in relation to the energy sector?
It's a super interesting one because there have been, at least from the UK to US anyway, several successful transitions and listings which have resulted in re-rating. So the companies being relatively lowly valued to being more highly valued, comparable with things in the US market. And conceptually, at one level, it makes a lot of sense. So the risks, as it were, associated with having anything denominated or listed in America are lower and therefore should command a higher valuation. So that makes some sense. And when we think about the businesses that have made that transition already, they have broadly speaking, have comparable fundamentals. And that, you made reference to a number of different metrics that you might want to think about it. And as it relates to oil majors, you would say, okay, that makes a lot of sense too, because by extension, there's been a lot of, in short, there's been a lot of government interference in the oil majors and what those business models are doing, not least, of course, as it relates to the energy transition and different countries having different demands placed upon these oil majors for things like renewable energy production, whilst trying to increase oil production, whilst trying to reduce emissions. So, some countries want one of one thing, some countries want one of another thing, and some countries want all of everything. So it makes it a really difficult backdrop for any oil major, particularly within Europe, to deliver against those multiple challenges that they're presented. And when you look at some conventional high-level metrics, yeah, the businesses do look discounted. So you quite conceivably could say, well, actually, yeah, that's a very reasonable argument, and sort of pair that with the simple fact that you have a high degree of government interference in Europe. Yeah, it makes sense that these should be discounted. But I think if you expand the scope, and valuation, it's more of an art than a science. But so if you expand the metrics of which you would look at many of these companies under, and some of the metrics, they actually look reasonably fairly valued. No, sorry, better way of saying it is that the valuation differential between the US and Europe as it relates to the oil majors, at least, are not that wide against some of these other metrics. So actually, I would say, yes, there would be an improvement in I guess, a marginal improvement in any transition of a listing, but actually, I don't think it would be as significant as perhaps you might expect, because on a fundamental basis, many of these businesses are not so different. There are some minor differences between them, and typically we try and express those by our preferences of any stock over the other. But it's not a massive discount, at least across a broader range of valuation metrics than some of these narrow ones. I think that it's an interesting one. It gets a lot of debate. And to your point around why might they want to tackle this, is because in the US in particular, these larger scale companies that have relatively premium valuations have of late been using them to their advantage to consolidate down the smaller companies. So basically increasing their position that they have, and they're only able to do that. And I think without exception this year, and last year actually, all transactions have been done using shares. So if your valuation is higher relative to another company, that of course allows you to do deals more often and also enhances your position relative to competition. And I think the point that was being made, particularly as it relates to Shell's comments, is that as a result of their valuation discount, at least on some metrics, their ability to do that is much less, and therefore they're at a disadvantage relative to their US peers.
That's really great, Jamie. Thank you for that. I guess we'll see what comes of it. Thank you, Jamie, and to Richard for those great insights, and to all of you for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners, so please review the show now, wherever you're listening, and share it on your socials, and tag us at quiltercheviot.com. To make sure you don't miss a future episode, please tap the subscribe button. And we are excited to announce an upcoming webinar where we will be joined again by best-selling author Tim Marshall on the 8th of May at 12 p.m. Many of you will know Tim Marshall as a leading authority on foreign affairs with more than 30 years of reporting experience. He was the diplomatic editor at Sky News and is the author of the #1 Sunday Times bestsellers, Prisoners of Geography and The Power of Geography. And this time the topic is the future of geography. So to reserve your spot, you can sign up via our website, LinkedIn page, or contact your Quilter Cheviot investment manager. We'll be back next week, and in the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribing to our weekly comment newsletter. And you can stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or on our social media pages. And finally, if you have any questions you'd like to ask one of our experts for the next podcast, simply ask them via the weekly comments page on our website. We'd love to hear from you. And that's it for today. So thank you to Richard and to Jamie for your time, and to all of you for listening. See you next time.